What's up, everybody? Welcome to Real Talk Real Estate. I'm your host, Mark Cannon, realtor here in Phoenix, Arizona with my home group Real Estate and owner of the Benchmark Real Estate team. Merry Christmas to everybody. Happy New Year as we get closer here in the holidays. But today we're doing our predictions or outlook for 2025. And we're trying to see what it looks like. Now, whether you're a normal listener or whether you're not, I appreciate you listening. There will be chapters at the bottom if you want to listen to different things. We'll talk through currently what's going on in the market. We're going to talk through, interest rates, inflation, all that stuff. And then we're going to look at predictions and outlooks for next year. What does that look like? What do we think is going to happen? So I'm going to go through all this. If you're not a normal listener to this is a podcast format. So I'm just going to be talking through it. I'll probably say something mess up, and it's okay. But I try to give accurate information. I'm trying to give information from a lot of different places. So there's going to be a lot of things on the screen today. I'm going to put a lot of charts up, a lot of different information. I'll put a lot of links and stuff in the description. So if you guys want to check that out, as always, if you want to, you can watch this on YouTube, Spotify, or you can listen to it on Apple Podcasts, Spotify, or YouTube, whatever. I appreciate everybody that is liking the videos, sharing comments. Appreciate that. Appreciate the feedback. So let's get right into it. I've got my notes. So got my notes here. Ooh, don't want to hit the mic. Jeez. Because I want to make sure that we get through everything today and without taking 30 minutes, right? So I'm going to try and be concise. So the first thing where we always start, how many homes are on the market, right? So right now we're just under 21,000. So that is actually a little bit down from where we were last month. So we were just above 21. I think we're getting close to 22,000. So because of that, we're going, okay, we've lost a little bit. I think obviously the election's over now, which thank God we don't have to have all those commercials and stuff anymore for the elections. But it's one of those that now that that's kind of over, people are starting to be a little bit more optimistic, or there's less dread, I guess, because when there's unknown like that with an election, people just tend to hold on and not do anything. So as well as we're seeing people kind of come back in the market. Now, the markets are fairly balanced, which I'll talk about in a second. But I wanted to show a couple different things just real quick. Because I'd always said normal in Phoenix was about 25,000 homes on the market, right? That's what I usually say, because that's what I've been taught. And I've been doing some research. And I was trying to find a really good chart as far as supply going back like 20, 30 years. Couldn't find one. Maybe I can find one in the future. But I was looking at this chart. So I'll show you this months of supply chart. So this months of supply chart is showing like you typically want somewhere between 3 to 6 months of inventory. 3 minimum is what you want. And we're just over that now, which is good, which is why we're in a more balanced market. So I think for me, like we'd always said 25,000 homes on the market. Some people would even say 35,000. I think that's too high. I think the new normal is probably around 20. 20,000, somewhere between 20 and 25,000 is going to be the new normal as far as what inventory is going to be. So I saw that. And part of that's because like when we look historically, yes, 25,000 homes may have been the normal, but with demand and how it's risen compared to like where we are now, like technically, yes, inventory is still low. So it could be 25,000, but I'm going to show you a chart here. We've had population growth in the United States. And so here in Phoenix, it's one of those that with more demand, there could potentially that maybe the new normal is a little bit lower than 25,000. But to me, I think it's somewhere between 20 to 25,000. And then this chart, this is a national chart. Again, real estate is local. It's not national. But this is a national chart showing that inventory is lower. So inventory is lower nationally. So, there are places that inventory is still much lower than it is here. Because again, real estate is local. It's not national. So here in this market, I always share the Cromford report. So if you're not familiar with the Cromford report, anywhere between 90 to 110 on their chart, the one I'm showing now, is a balanced market. Anything above 110 is seller's market. Anything below 90 is buyer's market. Now, I think, again, they're a couple weeks behind. So I think most of Phoenix is in a balanced market. The outskirts, as I always say, the outskirts are the ones that swing the most. They might be hot because they're the cheapest, but then they might go cold because they're farther out and people don't want to move there. So right now we're in that section where Queen Creek, you look out there at Maricopa, Goodyear, Buckeye, they're all in buyer's markets right now. So that's something to be paying attention to and what's going on in your market. Because no matter where you are, where you're looking, whether you're buying or selling, you should know what's going on in the market. I look at a lot of this data every week because I need to know what the trends are and what's happening. So we're going to talk about interest rates. Right now, currently 6.8% as of this morning. So 6.8%, we've come down. We were like 7.2 last month. So we have come down some. And again, I'll talk predictions of interest rates coming up. So pay attention for that. But I did want to kind of put it in context historically, because historically, where have interest rates been? So I'm going to show you this chart and take a look at it for a couple seconds, because this chart shows that if you look at interest rates over the years, now those gray bars that are vertical that you see, those are recessions. So obviously 0809 was the big one people think about, the big one in the 80s people think about. You look at those interest rates, we got so used to 3% interest rates. That is not normal. If you look at this chart, that is not normal. It was normal for 2010 or 2011 till 2021, and then it changed. So it's one of those that we got so used to 3% interest rate. I think we have to kind of get out of that realm of we're probably not going to see that anytime soon. I know people hope for that. I don't know that we're going to see that anytime soon. And some people are even saying we're not even sure if we'll see it in our lifetime again. And that's very possible. But with the government, you never know. They could always do something. So, but just with that, it's just one of those that, interest rates, I think historically when I was looking, is around 6%. So the past 30, 40 years, interest rates have averaged around 6%. We're a little bit higher than that now. So it's okay. So I think the new normal that people are going to get used to is 5 to 6% interest rates. I think that's what you're going to see. And that's probably going to be for the next 5, maybe 10 years, depending on what happens. Now, again, no one knows what's going to happen because the government can do all types of things. The economy can grow. There's tons of different factors, right? So, and sorry, I have a little bit stuffed up nose. The weather has gotten cooler here in Arizona. But yeah, so let's talk inflation real quick. So inflation is still a problem because as inflation goal is 2%, we're still above that. And we're going up. And that's the problem right now. Last month and October went up. So in September, we were at 2.4%. Then we went to 2.6. Now we're at 2.7. So it's one of those that it's not great. And the Fed is still cutting interest rates. And I know a lot of people are saying, well, the Fed's cutting interest rates, so mortgage rates should come down. No, that's not how it works. If you've watched some of my other videos, the Fed doesn't control the mortgage rates. The mortgage rates are tied more to, there's a couple different bonds, like the 10-year Treasury, I think it is. There's different bonds that's tied to. So it's not tied to the Fed. Now, a lot of times it does follow the Fed or get ahead of the Fed. It does bake it in and kind of do that. So I think we will see interest rates coming down, but I'll talk more about that in my outlook predictions section. But with inflation being higher, and when you look at the consumer price index, when you take out food and energy, it's a little bit higher at 3.3. So there's still progress that needs to be made, right? Inflation is still too high. Now, thankfully, it's not at 5, 6, 8% like it was. At least we're getting closer to 2. But a lot of the different economic places I'm looking, they think we will curb it next year, but it's going to take some different things happening. So the other thing to pay attention to as well is unemployment. And that's the biggest thing why people are seeing the Fed cut rates right now, is because they're watching unemployment rise. So when they're watching unemployment rise, they're saying, okay, we need to cut interest rates to battle that. That's why they're doing that. So it's not that they're not looking at mortgage rates and doing it because of that. They're looking at unemployment and a couple other factors. Now, again, I am not an economic strategist by any means. I'm not an expert. But just from what I can see, that's why they're doing what they're doing, or part of the reason why they're doing what they're doing. And the last thing I'll say before we get into the outlook for next year, what's to come, a lot of people are still on the bandwagon of, oh, these prices need to come down 100K. Oh, the crash is coming. It's just not there, guys. Unless something tragic happens that alters the economy of the market, I just don't see it. So I'm going to show you a couple things. So the monthly median sales price, if you look since 2011, we've been rising drastically. We've had an 11-year run up, 11 to 12-year run up in real estate. And then we've leveled out the past couple of years. And now, this year, I think we've been pretty level, to be honest. We were increasing, and then I think since July and August, we've kind of been slowly evening out. We're right near zero as far as whether there was gains this year. I think we're still there's different things you can look at, but some people are saying we're slightly negative gain this year in equity, or some it's slightly positive. It honestly could depend on what city you're in, too, because there are certain cities that you've had a positive gain this year. Like, for instance, if you're still in Peoria or if you're in Scottsdale, you've probably had a positive equity gain, whereas if you're in Buckeye or in Queen Creek, you probably haven't. So, again, it's all local. But then if you go back farther to 2001, I just wanted to show you this chart. You see it's continuing to go up. You see the big run up right there in, pretty much it starts at 05. and ends in '09. So that's when the crash happened. So, it's one of those that it doesn't seem like that's something that's coming, as far as a crash goes. So the last thing I'll show you is a lot, because the other thing people say is foreclosures are on their way up. They are, but let's get real about this. Here's a chart on what foreclosures look like over the past, what is this, back from 2008? Obviously, foreclosures were crazy, and we are not anywhere close to what they were. They have come up, sure, because there are people who bought with 8% interest rates that probably shouldn't have. Because again, like my philosophy is, you should be buying if it's feasible for you, if it's financially recommended for you. Some people are putting it there when, their mortgage is 50% of their income, and that's not a great thing. That's not something I teach, at least to my clients. All right, so now we'll talk about the outlook for 2025. Okay, sorry about that. I had to go blow my nose because I couldn't breathe. So let's talk about 2025. Now, I'll preface this as I've done in other videos when there's predictions or outlooks for next year. No one knows what's going to happen. So I'm not going to say anything definite. I'm just going to say from what the information we have right now, this is kind of the trends that we're seeing that could be happening next year. And I think a lot of it depends on the economy and policies that are done. And I'm not trying to get political with that, but obviously there are some things that could be happening next year that could loosen things up to help the market. So something to be paying attention to. So we'll talk about interest rates first. So as I talked about, the interest rates don't always follow the Fed, right? So here's a chart that I got from National Association of Realtors. And in this chart, they're showing that it's not exactly following the Fed, but they are expecting it to come down slightly. So this chart I got from US News. They are showing that they think that we're going to be somewhere, in the low sixes by the end of next year. So right now they're showing, we're around 6.7, 6.8, which is right. And then they think it'll go up here towards the very end of the year, early January maybe. But then they expect, I've laughed that they think it's going to, crater and then go back up. And when I see that kind of stuff, they clearly don't know what's going to happen, but they know it's going to come down over time. So it's like, okay, now I think personally, it's going to be lower than that. I think we'll probably get in the high fives by the end of next year. That's just me. Just based off of some of the things I'm reading and some of the people I'm looking at, and there's somebody else I'll show you in a second talks about that. But part of it, and again, not to get political with this, but part of it is based off of what the upcoming administration is saying and what they're going to do in kind of regulations. They want to build more homes. They want to do a lot of this stuff. That could have an impact on the housing market. So this chart I got from National Association of Realtors, where they're saying, like, if Trump does what he says when he takes presidency and does everything that he's doing, if they start building more homes and building the supply back up, we could see potentially maybe prices come down some, or even we see interest rates come down. So I think interest rates will come down. Prices we'll have to see. It depends on how much they can actually build and if they do that. So I think there is potential for, based off of what this upcoming administration is going to say, is that a lot of the things they're going to do could impact the real estate market, could impact people's pay. There's a lot of different things. So something to be paying attention to. So we do see interest rates coming down. Brian Buffini talks about, and I'll show this here in a second, or actually I'll show it now. Brian Buffini talks about his predictions. He thinks we'll do 4.5 million transactions, when I think we're just under 4 million transactions this year. And then he's also saying for interest rates, he's saying somewhere between 5.8 to 6.2% is where we'll be next year. And I think he's right. And he's been pretty spot on. He does these every year when he does predictions. He's pretty spot on and pretty close. So I think we will probably be fluctuating. And that's the thing, is you're going to see interest rates go up and down. So if you're looking to refinance, make sure you're paying attention. I'm trying to keep my clients up to date. Like starting in January, I'm starting to send emails updating people that might need a refinance of, hey, here's where the interest rates are. Pay attention. So that way when they need to refinance, they can. But as far as like home sales, so 2023, 2024 were really low in actual amount of home sales. Lowest we've had in, I think they said like 30 years, where since the 90s, where we've had really low amount of home sales. And a lot of that's because of interest rates, because of inflation, especially. And now we have people losing jobs, different things like that. So there's a lot of different things that are happening. And so that's where we're seeing, they're thinking next year we're going to keep rising. So NAR's chief economist said that they think that they're going to increase 9% home sales next year, and then 2026, 13%. So they see the next couple of years home sales picking back up. And a lot of that's going to be because is when you had people buying at 7%, at 8%, I can't talk. people buying at 7 and 8% interest rates. You're going to see them refinance. Then you're going to see other people who are looking to buy and sell go, oh, we're in the fives. Okay, now I'll sell my house, or now I'll buy. We have always seen it. Once interest rates start coming down, people start buying. So it's one of those that's going to drive people into it. I do expect, for me, I think we'll probably increase in transactions. I think they're right in that. We're going to see an increase in transactions, depending on, if the economy really does get better and people's jobs get better and there's a better sense from people to go and buy, interest rates come down, I think you're going to see people come back in the market. They're going to sell their homes. We've already seen listings starting to come back. So now it's, okay, now if buyers come back. So all that says, if buyers do come back, which there are a lot of people waiting, and if they do come back in to start buying in the 5% ranges, you're going to see inventory start dropping again, unless enough sellers can come back in the market to balance it out. So right now we're in a buyer/balance market, depending on where you're looking. So it really comes down to the data of, I think interest rates are going to come down next year. I think we're going to see inventory probably either stay the same or go down a little bit, with buyer demand picking back up. So if you're thinking about buying or selling, I would love to talk with you, because everyone's situation is different. I'm not a salesperson that's going to be like, you need to do it. Like, it's all about if it's right for you, if it's best for you. That's the way I run my business, is real estate through relationships. I want to help people. I want to help you grow. I want to be there every step of the way. That's what I do. I would love to talk with you. My information's below. I hope you'll reach out. I'd love to speak with you guys. I hope you have a Merry Christmas and a Happy New Year. And you've been listening to Real Talk Real Estate. I'll catch you next time.